Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Drew Meredith, welcome to this episode of the Australian Investors Podcast.
Good to be here as always.
Yeah, mate.
Back in my native home in the podcast studio.
Yeah, you're not at the beach house this week, mate.
No, never.
Learn your lesson.
I've had a lot of feedback about the quality of my recording equipment, so that's what's been driving that. We got some new headphones on their way too. A very big week.
Yeah, you've got a lot of feedback, and that's been good. No, but yeah, you said to me yesterday, I think it was the day before, you said you've been busy. Is that true or false? Can you confirm or deny?
Oh, I mean, it's kind of a cop-out answer, isn't it, when someone says you've been busy? But busy is what you make it. Good busy, bad busy. I think just good busy in that I feel engaged in a whole heap of things that I'm doing at the moment. So always positive.
Yep.
And there's obviously bad busy where you feel like you don't have any time and you're getting dragged into everything and can't keep up. So on the good busy end at the moment, hopefully the same as yourself, but again, working on holiday.
Yes. I mean,
really a holiday? You were at Molly's event last night.
Yes. Oh, yeah. Keeping tabs on me, I see. So I went up to the Ladies Finance Club in Brisbane last night because I'm here on the Gold Coast for a holiday. And yeah, it was really lovely. Like, it's always so good seeing all the ladies dressed up and enjoying themselves. Heard from some really good speakers. Caught up with Brendan Malone, CEO of Raise. Turns out we're both staying on the Gold Coast, so we carpooled on the way back. So you can imagine that car ride talking about finance and investing. And then, we heard some speakers talking about property in particular, and that was great fun. And it's really good because not just with the Ladies Finance Club events, but just kind of like all events when it comes to finance, there's like, in some respects, it's a very big community, but sometimes it's a very tight community in that people tend to know each other and mingle and network really well. And that's probably the most powerful thing that I find, in addition to some great speakers, of course. But just the ability to feel like you're welcome and you're okay talking about investing or money with someone that actually is passionate about it is probably the reason that you go to one of these events. And for me, it was great because I didn't have to speak, I didn't have to prepare, I didn't have to do anything, which is lovely for a change. So just to enjoy an event.
And it's a good opportunity to ask what a lot of people think it's dumb questions, but there aren't any dumb questions. I met some potential clients today, and it's just reiterating there are no dumb questions. This is your money. This is the decisions you're making, and you don't expect it to know everything, but having an open forum and hearing other people ask those questions can definitely help.
Yeah.
We know Molly's exceptional at doing that as well.
Yeah, definitely. And I think for the most part, Molly's just been really good at getting the right people to speak, and having the diversity in the voices is really nice too. So no, that's good. And the weather up here in Queensland has been horrible, so that's good too. Everyone makes the joke that I brought the weather with me from Melbourne, but realistically, it was already here, so I can't be blamed. But there was some interesting news, and I was just looking at this. You may not have seen this.
It's a stunner down in Melbourne today, by the way, too.
No worries. Okay, Drew, as of the 8th of October, because this is the data that I'm reading, as of the 8th of October, what has been the total return of the FANG ETF over 1 year?
About 12.5%.
43%.
Oh, damn it.
Over 3 years, what has been the compound return, total return?
CAGR, probably like 24, 23.
20.3.
I did say 20.3, not 23.
All right. I don't know.
It's pretty solid. I think there's a conversation we have all the time, and with clients as well. And I talked to our team of advisors about this week too, which was the fact that this is exceptional returns. Like, do not get used to this quarter. Australian shares, global shares are printing like 20% over the last 12 months, or 25 or 26. These are not normal conditions. you're investing in shares because you expect 8 to 10% per annum over the long term. And I think because of the last few years, there's been exceptional returns. I think it's important to kind of focus on not getting used to them and not banking on them. So understanding, putting it away, rebalancing portfolios, we talk about a lot. So even if it doesn't feel like you should, taking some out of your global and putting it somewhere else. But it's, I think reiterating that these are abnormal.
Okay, that's interesting. Negative, no worries. Okay, so
it's being realistic. You disagree? You're going to get 20% per annum forever? Maybe if you keep your Pro Medica shares, I'm sure you will.
Well, look at the Nasdaq 100 ETF from BetaShares. Disclosure, sponsor of the Finance Podcast. That ETF, I think that's unbelievable. It's like it compounded over 20% to 10 years. That's the entire stock market according to the Nasdaq 100. Okay, then. So if FANG's returned 43% in 12 months, what has the S&P 500 ETF, the IVV ETF from iShares returned?
About 23.
Wait, am I looking at the right thing? I think I'm looking at the US version. 1 second. I just want to make sure I got the Aussie dollar one. Okay. So for Aussie, it has returned, in Aussie dollars, it has returned 26%.
Pretty good. That was bad. Margin of error. The S&P hit its 44th record of 2024.
44th?
It's had 44 record closes.
Wow.
This is after all the calls last year that market was overvalued and the rally couldn't continue.
Yeah. What do you have? Like, think of everyone last year that was like, the US economy, dollar, Bitcoin,
it's over.
President, like
Ray Dalio, Bill Gross, Richard, was it Kawasaki? What's his name?
Kawasaki. He had some motorbike.
Kawasaki.
Yes, but it does sound like Kawasaki, if I'm being honest. So.
But everyone was like, and I did as Jamie and I, in our Waddle videos, we have a rant on, get it off your chest this week.
Yeah.
Mine was literally about the financial media, which unfortunately we're also part of, but just the headlines and the calls, like it's very difficult. You run the Rask Wealth portfolio too. It's very difficult to manage money for people. And it doesn't help when I'm just looking at the fin at the same time and there's just the headlines, CBA, it could be, everyone talks about CBA. It's CBA, it's China, it's Japan, it's everything constantly. There's so much noise all the time.
Yeah,
it's a bugbear of yours too, I know.
Oh yeah, I was talking about it today on the live show. We're recording this on Thursday, the 10th of October. I was talking about it with Pete today. Like the amount of news that you get. Like if you think about it, I don't know of any other industry where you have websites. If you think about news flow, there's websites that are specific for that industry that are amongst the world's most popular websites. So think about these websites like Financial Times, Wall Street Journal, the Financial Review. These are all websites that are finance websites, and they're amongst the world's most popular. And it just goes to show that most of the stuff that you hear in this 24/7 newsreel is just noise. It's just a complete load of crap. And that's why, we probably add to the crap part of it, to be honest, with this show. But I think, to be honest, like most people, when it comes to macroeconomic headlines and that type of stuff, the age-old Morgan Housel quote of 99% of long-term investing is doing nothing. The reality is that you probably only need a few days a year when you actually do something, and that's enough.
And that's usually a rebalance more than anything. It's not picking the next stock. It's literally rebalancing those 3 days a year.
Yeah, exactly. So we've got the Global X, sponsor of the show, Global X FANG Plus ETF is up 43% year over year. The iShares S&P 500 ETF, which is a bit broader, 26%. What is the VGS ETF up year over year, Drew? This is the global shares.
28%.
Close, 23%.
Oh, that's what I said for the other one. I should have thought it'd be lower than the S&P 500 because it has less exposure to those FANG stocks. I should have reverse engineered that one.
Okay, what about the Nasdaq 100 ETF, NDQ from BetaShares?
47%.
That's so ambitious. Let's have a look. 1 year, these are all slightly different dates, 27%.
Oh, that was disappointing.
It's slightly more than IVV and 5% more than VGS?
I mean, returns haven't been very broad this year. It's you've paid off for kind of core satellite exposure, so people holding big chunk in the index. And there was some data shared around this week about the global equity managers outperforming their benchmarks as well. But returns haven't been very broad. They've been concentrated on the Magnificent Seven, which has its own index now, the FANGs, which is like that plus 3, and I think it's like, is it 50% of returns from the S&P have come from those 7 stocks? Again, abnormal and highly concentrated.
Well, how's this?
But they're growing 30% on average per year, their earnings. So why not?
So the S&P 500 equal weight Aussie. So this is the beta shares QUS S&P 500 equal weight. Has returned
8%,
19.1%. So that's versus the normal market cap weight at 26%, according to beta shares. So in effect, being more equally balanced has reduced your return substantially, as has been more diversified yet again. So the similar narrative has played out over the past 10 years with US and global companies, is that obviously the NASDAQ 100 has been probably the premier index for the last 15, 20 years. But you need to have market cap weighting. You need to have the big stocks in there, which drive returns. It's interesting because I think you and I maybe spoke about this a couple of weeks ago. There was a question that came through actually, and it was from...
Those 7 stocks aren't immune either.
Well, that's it. Yeah. There was this other question that come through from Jules. Great question, quite long-winded. I'll just go into one part of it. No, it's good. It's a good question. Jules has been to the school of analyst.
Long in the tooth, usually, Coley.
One question, please. And then he comes up with, you got a 3-parter.
Is this a question or a statement?
He's come out and said...
financial advisors, if you go to a financial advisor event ever, they have a tendency to make statements and not ask questions.
And everyone's fallen asleep by the end of it, by the time they put the microphone down. So they've said, also looking at the Aussie ETFs, I understand the difference between VHY and VAS. So VHY is the high yield Aussie shares index ETF from Vanguard, and VAS is the ASX 300, so market cap weighted. But what I don't really have a grasp on is comparing their true performance. Has VHY outperformed VAS when including their franking credits / yields? Because if so, why wouldn't you just choose VHY? Even if they did show similar performances, wouldn't you still choose VHY? Because if both funds grew 10 to 30,000 over 20 years, I think percent, but VHY paid you $1,000 every year, and with growth products, VHS you had to sell to realize the growth. Doesn't it make sense to receive the money earlier in dividend form? So basically saying, would you go VHY over VAS? Now, VHY only has about 70 to 80 stocks in it. VAS obviously has 300. But my question to you on the back of the US stuff, Drew, was going to be, do you think right now there is merit in moving a portfolio from like Aussie index, where it's got like obviously BHP, Combanks, etc., and getting more diversification through a mid-cap ETF or a small cap fund?
100%. I don't think there's anything wrong with the index at the moment. And we've kind of seen, like the last 12 months, we talked about a few weeks ago, that the banks have added a lot in terms of market cap and they've driven most of the returns. But in the last 6 months, materials like BHP, Rio, Fortescue have added, I won't say nothing, but close to nothing. They've had their own issues. So you can see that by the index, yes, the banks are a big part of it, but there are other parts that can drive the returns of the index. So it still makes sense to have an exposure. The question around, and this is what we talked about before, when you've got, you're applying a rule that's worked in the last 12, 18 months, 3 years in comparing the income focused option to the market cap weighted option. So it's always I'm always careful about extrapolating those into the future. And can you restate? Oh no, we're talking about mid caps and small companies as well. So I think it's probably more important than ever, and I don't think it should just be applied to Australian shares either. We know there's massive concentration in Australia and there's massive concentration in the US and pretty much every other country. And what I think is more valuable than ever is real diversification, and that's diversification into different companies different sectors, different countries, and more importantly into companies that are, more mobile, efficient, innovative, and doing different things and exposed to different parts of the economy. So I think it's incredibly valuable. We've said that for a while though, and probably said it for 3 or 4 years, and mid caps have really kind of underperformed during that period compared to relatively to the ASX. The ASX killed it. So they have underperformed.
What do you think the ASX 300 has returned over the past 12 months to September 30, 2024? So 12 months.
17%.
Close. 21.6.
Yeah, 21.6, yeah. So, and that's just driven by the large caps. But for us, it's not just about what the returns have been, but where we, talk about Wayne Gretzky, where's the puck going to be, the value at the moment. And what we're worried about is if something, we had APRA change the rules around hybrids, which we talked about last week. If something happens in the property sector, something happens to interest rates, something happens to banking, we want to make sure your portfolio is resilient. Whatever we're managing is resilient to that. So best way to do that, different companies, different sectors. And I think as we invest, we have a bit of fun on the sides. We might hold a couple of direct stocks here and there. But you go on the S&P Spindices, S&P website, you can get the data on active managers outperforming. And it's always a big portion of active managers in small and medium, in mid-cap sectors outperform compared to large cap. There's a few reasons for that, but as you talked about with Dion and probably a lot of other people this year alone, there's just less research, less people involved, and therefore more opportunity.
Yeah, okay, I agree. Over 10 years, what's returned more? The high yield dividend shares from Vanguard, VHY, or VAS, the ASX 300?
VHY.
So over 10 years, VHY, that's the dividend one, 8%. VAS, 8.86.
Oh, close.
But over 5 years, it is the opposite way around. So in the last 3 years, dividends have reigned supreme as markets have got quite volatile.
And that'll be because the VHY pivoted into mining companies after they boosted their dividends, and then they're holding them once they cut their dividends, whereas they were always in the banks, probably. And that's the kind of backward-looking nature of Vanguard, of the high-yield ETF anyway.
Yeah. That's the thing with, to answer this person's question around what has actually outperformed, it's hard to tell because a lot of the times we don't get turnover data, so we don't know exactly what the crystallized tax position of any individual would be until they do their tax return, basically. And even then, it's virtually impossible to figure out. But then the other thing is, is every shareholder eligible for franking credits? If they are, and they're not taxed, like as in their retirees, then VHY is probably the better product for a big part of their portfolio. But of course, that means that they may miss out on some of the growth companies and some of the other things that happens over the next 5 to 10 years.
I mean, over 10 years, VHY, as the growth in it was 0.7%, 10 years per annum, and the distribution was 6.2.
There you go.
So you're literally paying it all out, and then you have to put it somewhere to get the compounding.
Yep. It's quite interesting because realistically, if you're in retirement, you need income, but you don't need all income. You want some growth to protect your wealth as well. So you'd have to reinvest some of that. There's actually an interesting thing here, Drew, too, which is something that I've been chatting to a few product people about. So people that create the ETFs and how they go about when they design an ETF, the things that they have to consider. I've been chatting to a few of them lately because they give us a call and they say, "Hey, Owen, we're thinking of creating this ETF. Do you think your audience would be interested in this?" And one of the interesting things is that a lot of ETF providers would love to bring out more dividend style ETFs. But one of the things that we're probably going to see, and one of the things that a lot of them are mindful of is hey, is there enough data on the companies, reliable data, to accurately track an index? And so what I mean by that is take the Vanguard one, for example. You could create a really dumb dividend ETF. You could have an ETF, to be honest, most individual investors kind of do this type of dumb behavior. No offense to people that do it, but it is pretty dumb. Is they just go to the last year's dividend.
Looking for some feedback there.
They go to last year's dividend payment, or they search their database, whatever it might be, like Ticker or a Morningstar database or something like this. They search for companies with big dividend yields and they buy them, which is very silly.
They call that a dividend trap.
Yeah, it's a dividend trap. And
sometimes it works for a while.
But my understanding is the Vanguard ETF used to do that. It used to just go and buy historical dividend pays, but then it realized that that can't work. You'll end up with dividend traps. So what they did was they changed it from backward looking to forward looking. They use analyst forecasts. So like, you get the Citi and the Goldman Sachs analyst research and you put it all together and you get a forecasted dividend instead of the trailing. But what we're probably going to see, I don't know, I'm interested in your thoughts on this, Drew, is we're probably going to see fewer and fewer of those analysts, like those companies providing the forecasts on. They might do still the top, 20 stocks, but they might not do 500 stocks or 200 stocks. They might not have enough analysts because no one's paying for that research. Do you ever think about that?
I mean, I always find it difficult for us or for me, most ETFs, we think about them as core, and I'm happy for that to be backward looking or size based or something that's easily measurable. As soon as you start doing forward looking, it feels active management and it feels like fundamental research. So, and that's where that problem comes in. But Vanguard generally, there's a little bit isn't known for being an active manager. But I think exactly the same. And that's what has happened. And you've probably seen this as well. I think there's a few products here, but one of the biggest ETFs in the world is actually covered calls. Which is an alternate form of income, and maybe that's a way that you're less reliant. You basically, you can explain it probably better than I can, but you're essentially selling a portion of each of the shares in the portfolio in the form of call options in order to provide a consistent income, and that income's more consistent than dividends will probably ever be. So I think that's why that's so popular overseas, and potentially that comes to Australia, and that's not forward-looking either. It's literally, basically, they're selling a portion of your shares for you to provide you with an income.
Yeah, so that's the covered call strategies are pretty interesting. So basically, what that means is like you have a portfolio of ETFs or shares or whatever. You just got something that you could sell, and you issue an option which basically gives someone else the ability to buy that at a future price, and that's a pretty interesting strategy. So you have, say, $100 worth of CBA shares, and you say, I will sell $100 of CBA shares at $104 if they ever reach that, and if in the next 90 days. And if it doesn't reach that, well, you get to keep the little fee that you collected
option
for that
premium. Yeah.
But if it does rise to that, then obviously you have to give them the shares. So you don't get the full upside, but you still get some of the upside. But the problem that we have with that now in Australia and those strategies is that the options market is actually drying up. But I take your point, generally speaking, that derivatives, and I think it's really interesting about the forward-looking nature. You can't just have that purely mechanical. You've got to have it as mechanical plus human overlay, because a lot of those businesses have complex balance sheets and complex income statements where you can't just go, big dividend equals buy, because there could be things in the financials that are bad or things in the financials that are good that you're going to miss if you use that quantitative approach.
Little biases creep in too. And you've seen some of the global ones, they end up having heaps of tobacco and telecommunications companies in there. You get biases that creep in because of the nature of the analysis or the figures they're looking for, which I think are unintended a lot of the time.
So Drew, question for you. Will the RBA drop interest rates between now and the end? I'd say now and March, end of March. So the first quarter.
March, yes. Yeah.
Wow.
100%. If you were going to say before December, I'd say no.
There's only one more meeting.
Before December. Yeah, November. Is there one in December? I think there's two more.
Okay, two more. Yeah,
so that weird one in the middle of September that everyone freaked out that I forgot about. They didn't invite me to the meeting. I didn't get the Outlook request, so missed that one. We're 6 months behind everyone. That would be first rate cut was in September. That'll make ours before March. I think that's definitely.
Yeah, but the Reserve Bank of New Zealand cut theirs.
You do a lock or something?
The Reserve Bank of New Zealand cut their interest rates 50 basis points yesterday.
50 bips. Everyone basically around the world has. New Zealand, we're a little bit more aggressive and faster up than we were. We've just been slower. We've been behind everyone else, and probably makes sense. We're so far away in such an export-driven economy because our borders were shut for so long. It took us a bit longer to fill brunt of inflation has taken longer to go away.
Yeah.
But yes, lock it in. My lock of the week if you watch Simpsons.
Okay, so you're guaranteeing everyone that listens to this show that interest rates will be cut before the end of March.
I'll give you a free book if I'm wrong.
Okay, you heard it here. Everyone, we've got a free book, drew@wattlepartners.com.au if it does not make the cut. So you're going to have to influence some people pretty heavily, my friend. To be honest,
Jay Powell's meeting was unanimous, wasn't it?
What do you mean?
They all voted for a rate cut.
Yeah.
Yep.
So, yeah, but interestingly, some of the data since last week? Since last week,
noise.
It's noise. There's been some interesting data come out. So the current expectations in the US market is that maybe rates aren't cut again anytime soon. So that's quite interesting if that slows down. What implication does this have for how you and Jamie and the team at Atchison manage the Wattle portfolios?
I mean, it hasn't been certainty around when rates would start to be cut. And the nature of our clients is that they're in retirement, so we don't want to be too far in either direction. But probably not loading up, but retaining bond proxies. So if you know what a bond proxy is, it's something that's interest rate sensitive. So listed property, infrastructure, those type of asset classes. I think I mentioned them a couple of weeks ago too. They'll benefit from rate cuts, and they really underperformed. But I mean, I did call property as one of the best performing asset classes this year, so I reckon listed property that is.
Have a look at that.
It's probably a question around. It was, as you were saying though, the rates were cut, bonds did incredibly well, but then bonds have started to do poorly again. So if the threat of rate hikes comes back, then bonds will do poorly, not overly poorly. But it's having a balance. So, for instance, one of the issues with holding a bank, just having cash in the bank at the moment, is that if rates are cut by 50 basis points, you're going to feel that, and probably then some, and your income will disappear quite quickly overnight. So how do you make sure you've got a mix of both those variable rate income sources as well as fixed rate? So we're still probably tilting more towards fixed rate bonds at the moment versus floating rate, and probably similar in the Rask portfolio.
Yeah, definitely. More towards fixed rate. But damn, I did not know that the Australian property, like REITs and that sort of stuff, property securities index is up
outperforming the NASI.
46% in 1 year, Drew.
Yeah, outperforming the NASI.
NASI, is that what they call it with the big wigs on Collins Street? So,
can we go back through all the episodes and see if I did call this?
I'm pretty sure you did. You said
healthcare, and
I'm pretty sure healthcare was more recently. But let's have a look at the Charter Hall. Oh, Charter Hall, long WALE REIT. That's CLW as a ticker symbol, plus 26.6%. Drew,
give us a 6 month.
Give us a 6 month. He says 10%.
Clear Head and Shoulders. Oh, sorry. Damn it! I was trying to find that bottom
reverse triangle going on here, which is still a triangle, if I'm not mistaken. But it's quite interesting. Let's say you include half of that 6% dividend yield, you're getting about a 12% return in 6 months.
Yeah.
Year to date, same thing. It's pretty good.
These arbitrages can disappear quite quickly though. Like you're essentially saying there's a bit of an arbitrage here. So Charter Hall, Vicinity, a lot of the Dexus, a lot of the property trusts were trading at discounts to the net tangible asset value. And what you see, apart from listed investment companies, is that those discounts tend to disappear as conditions normalize, and that's essentially what you've seen here. Like, there's no change in the assets held by those trusts. Essentially, the expectations are catching up with where the market is.
Yeah, but capitalization rates and interest rates, and I read something in the AFR that said something about something.
I mean, cap rates did blow out, and that's why they all performed so poorly 3 years ago, and probably 2 years ago as well. But I think it's finding those pockets, and those pockets are getting more important. Could be smaller companies, it could be micro, whatever your pocket is. But when the S&P is hitting 44 record highs and the ASX hitting record highs, you don't necessarily have to sell them, but it's good to be putting incremental dollars into some alternatives.
So why would you now, so you said before, like with the interest rate setting where we are, where interest rates might slowly start to fall here in Australia, the global consensus is falling interest rates. Why then would you position in these types of things like property securities, infrastructure, etc. Like you said bond proxies, but what does that actually mean to someone that's listening or watching? What does that actually mean?
It means that they benefit from rates falling. So a lot of these trusts have debt secured against their property. So if interest rates are falling, cost of their debt reduces, their dividends and distributions potentially increase, but also the replacement value, but also the comparative value and the attractiveness of those. So if you get 5% on your cash, then 5% from a property trust isn't very attractive. But if your cash is now giving you 3 and your property is still giving you 5, well, 5 looks more attractive again. You're getting rewarded for that additional risk. So that's why these things tend to do well as interest rates fall and the value of those assets. Essentially, every asset in the world is valued on interest rates in one way or another.
Okay, cool. Yeah, no, I like that. And what does Buffett say? Interest rates are like gravity.
Yeah.
And they go up, things come down.
Yeah, they go up, things come down. Yeah. We spent a long time with them at 0, so.
Yeah. So there was a question that was sent in from Solar, and I think you added in your notes for this week's discussion, which was about the Rio Tinto bid for Arcadium, which was, Solar says, how much would Rio Tinto pay in Australian dollars to acquire Arcadium Lithium? Can you just sort of set the scene? Maybe just tell people that have no idea what the heck's going on.
So there's been not many deals in markets, maybe more takeovers, no IPOs, but the biggest deal in markets the last week was Rio Tinto, Australia's second biggest miner, I'm thinking. Mainly does iron ore. Made the call to friendly acquire Arcadium Lithium, which was the combination of Allchem, from memory, and Livent or something. So 2 other lithium companies. For context, lithium prices are down something like 90% over the last, I think, 12 or 18 months. Like lithium was one of the hottest things again. Financial media headlines, everyone pumping up lithium for a while. But the sector's very struggling. And when the price falls, it means mines can't make money. Mines start to shut down, the price goes up again. So they basically made an all cash offer, I believe, for Arcadium Lithium. And I mean, this is a tiny company compared to the size of Rio, not a tiny company on its own. And that values the company at 10 billion to the share price, which they're saying is fair, which could tell you, the company was undervalued. But, Rio Tinto is a 100, and this is one of the interesting things. Rio Tinto is paying for this without having to impact their dividend policy. So basically, we're going to put some profit in to buy a whole new massive, I think that makes them the second biggest lithium producer in the world, Rio Tinto. The assets that they're buying are alongside some others in Argentina, which puts them like a very big, not necessarily a financial bet, but has a massive exposure to lithium for the next 20, 30, 40 years. Interestingly, and probably bad for investors, was that the merger of those 2 companies that became Arcadium had the business was valued about 15 billion when that happened. So essentially the company's worth a third less, and it's been taken over by Rio Tinto.
Yeah, look at that share price pop there. So it was $10, fell to $3.44 recently.
Down 60%, yeah.
And now the offer is like $8.20. Yikes. I mean, but that's interesting. Do you think this is a mistake?
A mistake by Rio?
Yeah.
I mean, it would be a mistake if mining companies in Australia have a history of buying things when they're overvalued. This actually looks like they're doing the right thing. We've talked about BHP, Newcrest, and all the acquisitions they made at the top of different markets. This looks reasonably cheap, and given their size, it's interesting how they can get such an important role in lithium markets while not paying all that much in context. It doesn't seem it seems like a pretty good idea.
All right.
I've been told to have more opinions, so.
I have more opinions, Drew. So, not from me, by the way, guys. I'm not saying that. After that whole Dr. Andrew Derrimouth thing of 2020, I'm
so tired. I'm going to come up with a new pseudonym.
Wind that back, Drew. Come on. Hey, boy. Bring it in. No, but seriously, would you rather buy Guzmen Y Gomez, go 10-year view? You have to watch it. Like Guzmen Y Gomez, Rio Tinto, or Charter Hall Long WALE REIT, CLW. 10-year view. Mexican food?
Rio.
Iron ore and lithium?
Rio.
Property?
Rio Tinto.
Rio Tinto.
Yeah.
Over Guzmen.
Over Guzmen.
Talk to me about this. How did
There's
you
only
get
so much Mexican food you get. Look at Chipotle in the US. Things struggling too now. Guzmen, yeah. I mean, I've actually never eaten there. I probably should change that soon.
Just you say that because I had a good feed of Mexican. There is a lot more Guzmen Y Gomez up here on the Gulf than I've ever seen. I don't know what that says.
I think it's got to be Rio. Guzmen, it's more like the pricing of Guzmen. And then the second question would be maybe they'll go global. I'm not sure they're global yet. But there's only so much you can expand in Australia. Yeah, the share price might run, but you hit peaks like they do with Domino's. And then when you go overseas with a franchise, it's always difficult. And if you've been to LA before, there's no shortage of Mexican joints, literally everywhere. So there's a lot more competition in different markets over there. And Rio Tinto, China, I still see China as being central to global economic growth for the next 20 or 30 years, as much as people don't pay attention. This week's data, their stimulus a bit underwhelming, but iron ore, and this pivots to the second biggest producer of lithium. We know they keep trying to find alternatives to lithium, and the market will turn eventually. So I like this one. I know when Charter Hall, Charter Hall is a great property asset, and we hold it, but it's more like you're not expecting, home run growth rates from Charter Hall. You'd need interest rates to fall back to zero to get that, but solid income and some consistent growth.
So using the most trusted source for financial data on the planet, which is Google
ChatGPT. Oh, sorry.
Google's number 2, but it's still very respectable in how well it stuffs up all the data. Since 2006, which is the furthest back I could go in Chipotle's history, how much has the stock price returned since 2006, Drew?
12,000%.
6,700%.
Oh, it wasn't bad.
Good. You're only a doubling away. 5 years, 250%. So its CAGR is off the charts. Like a lot of burritos are being made in Chipotle. 3,500 restaurants. Okay, so now I'm going to zoom that back in. So instead of 10-year view, you've got 3-year view. Charter Hall, so play on property, interest rates, blah, 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 blah. Rio Tinto, probably a botched takeover into lithium, let's be honest. And 3, what was my third one? Guzmen Y Gomez, overpriced Mexican.
I think it's pronounced Guzmen Y Gomez too, not Y.
Why? Yeah.
GYG. I'm still going Charter Hall. You just want me to pick Guzmen Y Gomez because you want a headline. Financial advisor picks GYG.
Best interest duty.
I don't know. It just doesn't sell me. Maybe it's because I haven't eaten the food, but
that's good.
And it's not, if you've eaten like tacos in Mexico, it's very, no offense to GYG, but maybe send us some free food and we'll just the value seems tight. I don't know. They kind of got that IPO up and they're very aggressive store expansion plan. And there's a risk it just becomes a kind of mature grower.
So you would go on a 3-year view, which is basically technical analysis. You're saying Charter Hall, Long WALE REIT. Over a 10-year view, you're backing the mighty Rio Tinto, the Red River.
Yep. And over 3 months, I'll back GYG.
Over 3 months, momentum trade. Okay. That's good. Yeah, that's good. So I've got GYG out of here. But that's really interesting. So I would probably go GYG over 10 years, to be honest. Just as like it's a satellite, whatever. If it was more of a, Owen, put your sensible hat on, this is someone else's money, I would probably do Rio. Because I think something like CLW, like Charter Hall, it should compound, particularly if interest rates plateau, but it's not going to grow. It's not a business per se. You own properties, which is a quite different grower over the really long term. But yeah, it's interesting because in the city of Melbourne, the mighty city of Melbourne, there's another brand called Zambreros, Drew, if you get to the Mexican joints. And that's
the only Mexican place in Wangaratta.
Yeah, and that's very good in Wangaratta. It's Wangaratta, shout out to people in regional Victoria. It is incredibly busy in Melbourne is Zambreros. So I don't know if the GYG juice is rubbed off.
Is it like a Porto and Nando's, where Nando's used to rule Melbourne and a Porto used to rule everywhere else?
Maybe, but I think Zambreros is very, very, very popular.
Yeah.
So Um,
And how do you differentiate?
ethos, maybe. Logo.
Because people pick Mexican food on ethos. Logo, location, probably just location, ease.
Taste maybe has something to do with it.
Yeah. Maybe next time we'll do a side-by-side tasting.
Yeah, we could have burritos while we do it. But I got to admit,
Salsas is pretty popular too.
isn't that dead in the water?
I don't know. I think I had one at Northland the other day.
So anyway, it's kind of like Yelp, I guess, is salsas. The Yelp of burritos.
Yelp.
Next up, we've got a really good, I guess, question sent in, but I might skip that one and go to the less good ones. No, I'm kidding. There was a question sent in by someone called Stock Loss, which is a play on stop loss, Drew. What would you do with a stock where your position went from $5,000 to $500?
Cut it.
Just using these numbers as an example, they say. Hold and forget about it, or ... Drew?
I think the example we had before, Arcadium, not that you'd sell, like, that's a different story, but the risk of what happens when these things fall by 90% is that they get taken over and you never get your money back. They get taken over, from $500 to $1,000 in this. It would have been similar in this case. And you never really get your money back. And it's always, for us, what's the holding cost? We've had plenty of dogs. Our entire process is aimed at getting rid of the dogs. You and I have had dogs. Everyone's had dogs. You don't really regret selling your dogs. Yeah, you might keep looking at them, and Magellan's one that I've had. You keep looking at it, or AMP, and they never, they very rarely come all the way back. And two, just fundamentally, if they did double, in most cases, they're still not going to impact your overall return and provide that much benefit. And you're more likely to find a much better company by just cut your losses, remove the emotional bias, and move to something new. And try not to do it again.
Just for those people that are listening, we're just bringing up Magellan.
Chart on, Owen.
This is not a chart, Chrome. So yeah, it's down 75% over the last 5 years, but that's, cherry picking the data here. Let's go back a bit further. Yeah, so it had a big run up, as everyone knows, went from 20 to over 50. Wow. And now it's back to $10. Offers a decent dividend yield. Funds management business, more diversified than it was before, you could say. But obviously, funds management businesses rely on funds under management to squeeze the cash flow out. So,
look, if you held it in 2022 and it sunk 60%, 70%, and then you sat there and went, oh, yep, I still like the company. I still got that. You're still waiting 2 years, and it has barely.
Because if you think about this, if you looked at that and you bought, say, this is just an example with Magellan, we love the people from there, but if you looked at Magellan stock and you were like, well, it was $33 when I purchased it 2 or 3 years ago, and now it's $10. You're like, oh, okay, that's you think it's get back there, but it's already gone up 50% this year, and it's still not scratching the surface of what that person would have paid for it. And so that's kind of the big thing, is like every time you lose money, you need to make more on that rebound just to get back to even. And a good example of this is Zip Code.
And the company's changed. Like, this is the thing. That used to have 100 billion. Now it's got, I think, 30 or so billion in assets under management. It's not the same company it was.
Yep, that sounds about right. But Zip, however, Drew, take a look at this.
Look at that chart. What? It's back to $3. It's amazing. Have we got any news on that yet? No, we don't.
Look at the year-over-year return, son.
1,000%. Yep.
It's a 10-bagger in 1 year.
Credit to me.
You were almost back in the black, son.
Nearly. Just needs another one of them.
Still doesn't offer a dividend yield, but that's okay. But you could be back in the black.
But then if you look at that chart, if you bought it at $6, you're still down 50%. This is the thing. If you lose 50%, you have to gain 100% to get back to where you started.
Yeah, but you could be, back in, your blended price was like $4 or $5, wasn't it?
Yep.
Wow.
I locked some money away and put it in some other things that went up. That's the thing. I did lock some money away, took some profits initially, invested that into things like the trade desk and other companies. So you've actually used some of your winnings to turn into separate money. And that's where you have to disassociate with your losses and remove that emotional connection.
Yeah.
Yep.
I haven't been as, I was
Do me.
I don't own Dubber anymore, but and then finally, our friends at BrainChip look like they're on the way back. But I mean, if you paid $1.60 for it at 31 cents, it's still a bit ouch. So crazy thing about BrainChip is it's still got a $608 million market cap. This is the company from a few years ago, folks might remember, that did AI on the edge or something like this. And it's been a bit painful. So the thing is, rule number 1, don't lose money. Rule number 2, don't forget rule number 1, I think is the key, particularly as you become more, you have more money, it becomes more important. Yeah. So maybe we've got time for one final question, Drew. I know you had a great big question that was sent in from David. So we might get to that next week, actually, because it's a really good discussion about what to do to supercharge and juice your retirement. Now, you've got the Australian Retirement Podcast for folks that haven't tuned in with you and James. It is shooting the lights out, shall we say.
Is it?
Oh, yeah. The Australian Retirement Podcast is easily the biggest podcast launch we've ever had at Rask. Easily. It would be 3x bigger and faster than anything else we've ever launched. So credit to you. I can say that. It's credit to you. Well, mostly to James, but some to you as well.
It does seem like that, but there is there's an unmet demand. Like every person we meet, and there's just the unmet demand for it to pass on retirement. And hopefully, it's even the most same as this one, the most basic starting point for people to get engaged with their money.
We are very advanced here on the Australian Investors Podcast.
And their dad jokes.
Thank you very much. So Optional, which is the name of the person that wrote in, which is a great name as well, because it is optional. And you wrote that in, which is very great. You did give me some ideas for failed companies. Now, this is important, Drew, because over on the Rask YouTube channel, I run Rask Invest Live every Thursday at midday. It's a live show. And I am introducing a new segment to our weekly show. It's going to be like once every now and again type format. We're doing Nightmares on Collins Street. And that's the format. We're talking about some of the absolute shockers. So it'd be like, normally it'd be like Nightmare or Wall Street, but obviously Wall Street's American. We've got plenty of our own scams, dodgy spruikers, pump and dumps, terrible companies, people losing money here in Australia. We don't need to look overseas for inspiration. So if you do have any examples of scams that you've been caught up in, any like dodgy operators, please write into me, because I'm going to summarize a lot of them. And the idea would be that, misery loves company. Plenty of us have been this victim of these types of things, or nearly the victim of scams and hoaxes and whatever. And there's no shame in it. It's really just to teach other people what to look for and to tell that through stories. So if you do have any examples of dodgy practices or things that you've come across over the years, you can stay in, you're not going to be on air. You're just going to tell me about them privately, and then I'll summarize them. Write into me. You can use the community, or you can use the Ask a Question link. And finally, I just want to sprinkle something into the kind of the marinade of Rask podcasts over the remainder of this month, Drew, which is that by the end of this month, so by this time next month at least, Rask will have a totally new look and feel.
Beautiful.
And with all the scams and things that are going around, I don't want you to think that something's happened to
Somebody's taken over.
Yeah, we are changing the way Rask looks, the way it feels, our websites. Everything is safe. Everything is secure. Everything is still us.
We're getting haircuts.
Getting haircuts.
Owen's growing a beard.
I'm going to just go goatee. I feel like goatee instills
trust.
No, I used to have a rule when the analysts used to come to me. I said, does the CEO have a goatee?
No, I'm out.
No, not happening. But then maybe, because Aram Arakazami from Altium, which was like a 50 bagger, I think he had a goatee.
Oh, maybe it's the length of the goatee. Who knows?
Maybe, yeah. Handlebars, maybe. I
can test it if you want.
You will, or whatever his name is.
Pull the goatee.
So final question, which is this, Drew. It's from Cassius Clay. Sounds like a good questioner. Hi, legends. I'm about to sell my home, which is fully offset, and I'm going to rent interstate for 2 years. I expect to have over 1.6 million from the sale in addition to our investment portfolio, and I plan to buy a property over $2.5 million when I returned. So this is in 2 years, Drew. Good on them, by the way, I should say. Like, congrats and well done for getting to that position. They go on to say, should I consider a term deposit, bonds, corporate bond ETFs, or something else to keep my cash safe and give me the best returns for this period? Also, would it be wise to consider consulting a financial advisor for this period, given the risk of being out of the property market for that time? So there's 2 questions, Drew. One is 2 years they plan to make a purchase, and they've got about $2.5 million of assets by the sound of it. The second one is, could a financial advisor help them with this? Discuss.
I think an advisor can definitely help, but I'd also say you have to be incredibly clear on what you're looking for. Like, if you have a specific goal and a specific amount of money you need, conservative advice would just be, do not take any risk with it. If you're actually going to need all this money for that purpose, just put it into diversify your term deposits and just lock it away. There's tax impacts of that. There's all kinds of impacts of that, but that would be like the 101 starting point. If there's some kind of umming and ahhing about that property purchase, then an advisor could probably help in terms of, is it worth having some other assets in there? But if there's a specific need, I'm very conservative on this and just say, just lock it away. Don't take any risk. This is a specific need you're going to have. And if you don't have it, it's going to impact you significantly.
Yeah, I would agree with that. Just cash.
Cash. Take it out of the bank run, put it in there.
What?
Don't put it under your bed. That's all right.
You need a big jar to bury that amount of money. Yeah.
Couple of briefcases.
It's 2 years is not enough to invest. Even in a corporate bond ETF, even in one of those, why would you take the risk? If you've got a big lifestyle goal, 2 years, maybe if you said 3 to 5, then you could maybe stagger some balanced portfolios or some credit and some bonds. But even bonds, interest rates might go up and your bond ETF might fall 5%. Is that what you want? Probably not. So simple. And I would say, to be honest, this is a person that's obviously either through whatever means, they've ended up in a situation where they've got a very strong equity / cash and financial position, and good on them. But that's the thing. Don't stuff it up. I think an advisor in this situation is more like a sounding board, a second opinion. Even if you just go to them for advice and not implementation and ongoing, just get advice from them, pay them a lot of money, to be honest, to give you a really good set of scenarios that might apply to you. And have that confidence, because reality is you pay a financial advisor. If you've got $2.5 million in a few different TDs at this rate, the cost of the advice is virtually negligible in the scheme of things. So get the advice, I would say. It's a good first protocol. Now, Drew, you could give us a dad joke.
I really think you're going to enjoy this one. I really like this one.
Hold that for a second. If you do want financial advice, anyone listening, you can head to the link in your show notes that says ask a question. Just as an FYI for everyone on that, all of our courses, the Rask Media website, our membership, even Rask Invest is all going to change over the next 3 weeks. So the next time you visit the website could be a big upgrade on what you see today. And I'd love to know what you think. It's not there yet. It's going to be about 3 weeks, but the countdown is well and truly on. I actually liked all the questioner names: Jules, Stock Loss, Catchiest Clay, Optional, and Solar. I thought they were all really great names and good questions. So if you were any one of those people, send us an email, use the instant chat widget on the Rask websites, and we'll organize for you to get a pass to the Value Investor program worth $499. It's my complete training on value investing and all types of investing, and a free book, Drew at wattlepartners.com.au. And don't forget, Siri is always listening. So at March next year, the end of March, we're all 20,000 of us that listen to this podcast are going to email Drew and say, you got it wrong. Where's my book? Drew's going to incur some serious Amazon charges, and Jamie's going to look at the bill and go, what the hell is this? But Drew, if you're right, that's good news for people that own bond ETFs, property. It's good news for people.
Good news for everyone, generally, basically. Yeah.
Basically, except for retirees that rely on term deposits. But if you're a retiree, you start locking in some term deposits now, basically. So
exactly.
Drew, dad joke. Take us off into the sunset.
This is for all those, going out on a date night, eating and that sort of thing.
Where is this going?
Did you hear about the restaurant on the moon?
Yeah.
Great food, no atmosphere.
Now, as a big space nerd, Drew, I've got to say that That's not technically correct.
Oh, damn it.
I will take that as a very good joke. I will give you a solid 8 out of 10.
Oh, I'll take it.
Yeah, that's very, very well played, sir. Drew Meredith from Wattle Partners. Hopefully we can do this in person next week. That'll be a bit of fun. If anyone that wants to get in contact with you, wattlepartners.com.au. Check out Wattle on YouTube. It's coming soon. Mate, always a pleasure.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.